Welcome, and thank you for joining me for this weekly episode of the Market Whispers podcast. I am your host, Beachman, and I am super excited to have you here today. Today is Friday, May 31st. Now, right off the bat, I must clarify that I'm not a financial planner, and anything that you hear or read in this podcast is not financial advice. So please do your own due diligence and consult a licensed financial planner. And before I forget, please do me a favor and spread the word about this podcast and my newsletter. I keep the cost for my paid content very reasonable. It costs less than 3 lattes per month. My paid subscribers know the value that they get from my research, from my writings, from my market analysis, from the active chat line during market hours, and from this podcast. Just recently, in fact, just this week, I wrote to my paid subscribers about my take on the Q1 earnings for about 15 stocks on my watch list. In that post, I discussed what I liked about those specific earnings reports, what I was concerned about, what the Beachman score came out to be. As you know, I score each of these stocks using my Beachman scoring algorithm. And then I identified one stock that is now high on my watch list and the reasons why I like that stock and why I'm watching it going forward. So please consider becoming a paid subscriber. Tell your friends and family. I'd love to have them and you join the growing Beachman community. Now, a few quick PSAs before we get into the meat of this episode. One, this podcast is also available in YouTube format. If you search for Market Whispers by Beachman or Invest with Beachman on YouTube, you should be able to find my channel there. Secondly, I wanted to inform you that the transcript for this podcast is now available for reading on the Substack website for this particular episode. If you go to the Substack website for this episode, you should be able to pull down, the full transcript for this podcast and read through it as you would like to, or if you would like to read through the written content instead of listening to it. And thirdly, please take a few seconds to like this episode or drop a comment. I'm personally too old to care about likes and thumbs ups, but the algorithms on Substack and YouTube, well, they do care about these likes and thumbs ups. So your likes, your comments, your engagement with me through this episode will help the algorithms understand that more readers, more people like you need to find my writings, to find this podcast, and this will help us grow the Beachman community. Now on to the meat of this episode. Well, as of today's close of the markets for this week, the Dow Jones lost 1%, the Nasdaq and the S&P 500 were flat for the week, and the Russell 2000, the small cap index, gained 1%. So far for this year, the S&P 500 has gained 11%, the Nasdaq has gained 11%, and the Dow Jones index has gained 3% for the year. The best performing industry in the S&P 500 this year is, no surprises there, semiconductor and semiconductor equipment stocks. They gained more than 56% for the year. The worst performing industry in the S&P 500 is automobiles and automobile parts and components. That sector lost about 23% for the year so far. After a relatively docile grinding prior week last week, markets certainly gave us some food for thought this week, and in fact even today. Trading volume in markets has been declining since early May. And that's actually normal for this time of the year, because as the summer comes around, people, traders, investors start turning their attention away from markets, away from their screens, and they start thinking about their upcoming vacation time. In today's relatively docile market, some growth in tech stocks have started trading like crypto NFTs. This low volume accentuates these movements in stocks. This low trading volume in the market tends to accentuate movements up or down in stocks and ETFs and even the indexes. Some growth stocks and tech stocks have seen double-digit positive and negative moves on a daily basis, typically in reaction to an earnings report or a press release or an analyst upgrade or downgrade. Now, even as the concentration in large tech stocks has accelerated, The top 10 company share in the S&P 500 index has reached a new record of 35%. So the top 10 companies in the S&P 500 index represent about 35% of the value in that index. This is the highest recorded percentage over the last 50 years. Over the last 50 years, we have not seen this kind of high concentration of value within the top 10 stocks in the S&P 500 index. This now exceeds the 2000 dot-com bubble peak by about 8 percentage points. In 2000, that was as high as about 27%, and now it's at a 35% rating. Meanwhile, Nvidia alone has contributed to about 39% of the S&P 500's market cap year to date. This market seems to not be able to function without big tech. But when it turns against a tech stock, it really punishes them, as we've seen with today's 20% drop in the Salesforce CRM stock. Just yesterday, 20% of all S&P 500 companies made a new 3-month low. This is the most since last October 2023. Callum Thomas wrote about this effect on Substack recently. He said that 50% of stocks in the S&P 500 are below their 50-day moving average. Even the breadth indicator has put in a lower high versus the index putting a higher high. This is what technical analysts call a bearish divergence. This is a short-term risk flag. It's a prompt to pay attention to the risk that might be developing under the covers in today's markets. Wall Street Journal reminded us about how all the bulls earlier this year were getting excited about the fact that the rally seemed to be broadening out beyond the magnificent 7 stocks, the 7 mega cap tech stocks. All the bulls were excited about the fact that this broadening out of the rally, these wider gains, were a sign that perhaps the market's rise was sustainable. Perhaps we were in a new bull market. But based on the last week, it seems that that's not true anymore, or maybe there is some doubt behind that thesis. This month, as indexes hit fresh records earlier this month, it was just 4 giant technology stocks that added more market value to the index than the rest of the S&P 500 put together. A brief burst of outperformance by small cap stocks seems to have petered out. Nvidia, Microsoft, Apple, and Alphabet, between them, those 4 have added over $1.4 trillion in market cap this month. This is more than all of the other 496 stocks put together. Half of that gain that we just talked about comes from just one company, chip maker Nvidia. Now, behind the rises in the biggest stocks this month and this year itself are just 2 trends. And these 2 trends have already run a long way. The 2 trends I'm referring to are artificial intelligence and higher for longer interest rates. Now, AI is something that we've talked about in length, and we actually are going to discuss it some more later on in today's podcast. But let's talk about the second effect, the second tailwind, higher for longer interest rates. Higher for longer interest rates are actually helping these mega cap companies, because it gives them a 5% or more interest return on their very large cash balances. And this helps them to boost their earnings quarter over quarter as long as we have these higher interest rates in place. The NDX, or the NASDAQ 100, has not had a more than 9% drawdown this year at all. But the average stock within the NASDAQ has already had a 35% drawdown this year. And then there's the effect of the zero DTE options trading on intraday market action. We saw that in play today. So options trading are at their highest volume ever. I saw some reports that we even have international options traders that are actively participating in the options market in the US during US market hours. Now, zero DTE options trading has taken off, and they currently represent about 45% of all options trading volume that happens in US markets today. We've spoken a little bit about zero DTE options trading before. So zero DTE options are options that expire the same day. So they are options that expire before the market closes today. Now, when 0 DTE traders are bullish on a particular day, they tend to buy call options that morning. Market makers are traders that take the other side of the trade, meaning they are the ones that sell these calls to the 0 DTE options traders. Now, market makers make money on commissions on the trade. They don't make money on the trade itself. So, as per their rules, they sell their calls to the options traders and then they hedge their trade position by buying the underlying stock. This helps the market maker stay neutral or market neutral. So this increasing options call trading plus the buying of the underlying stock by market makers to hedge their positions has a dual bullish effect on markets that day. Now, 0 DTEs, these options, they expire before the end of the day. So these traders are prone to closing their options positions before the markets close, and typically that happens about an hour before markets close for the day. So that trader will then try to sell their call options by around, let's say, 1:30 Eastern Time. That trader will try to sell their call options. Those call options are bought by the market maker, so the market maker buys their call options back. And then the market maker sells their hedges, meaning they sell the underlying stock that they have bought. So now the market starts dropping into the close. So on a bullish market day, 0 DTE traders tend to enhance the bullish upward movement of markets. And all of this happens in reverse on a bearish market open. So take a day like today. Today what happened? Markets opened weak. 0 DTE options started buying puts or bearish bets on the market. Market makers started selling stocks to hedge their positions. And then suddenly we had an intraday reversal in the early afternoon where 0 DTE options traders started closing their put positions to book gains. Market makers started closing their hedges. And now suddenly markets started moving higher. So options trading continues to accentuate market swings on a daily basis. And this is even more accentuated during earnings report season, when we get an analyst rating change for a particular stock, or when there's other significant corporate news releases or news items about a particular stock. Everything seems to be moving up or down, higher or lower, faster than usual, violently faster than usual. Now let's talk about what's the word on the street. Now in this new segment, What's the Word on the Street, we will cover some important market updates and events. We will also cover some key macro updates we got over the past week. And then we'll also touch upon some important business updates that investors should know about. So let's dive in. Well, today we received a very important inflation report. We received the PCE inflation report for the month of April. PCE inflation rose 2.7% year over year. This was in line with forecasts and flat as compared to the previous month of March. Core PCE for the month of April, that was up 2.8% year over year, again in line with estimates and again flat as compared to last month. Now remember, PCE inflation, this is the Fed's preferred inflation index. And PCE inflation has been range bound for about 5 to 6 months now. Yesterday, we got an update on the US's Q1 GDP growth. We got the second reading on our Q1 GDP growth in the US. And this reading was not pretty. Now, if you remember, the first reading came in at 1.6%. This was much lower than the 2.5% that was expected. And this second reading we got yesterday came in even lower than that, came in at 1.3%. So the US economy grew at a 1.3% annualized rate in Q1. This is the lowest reading that we've received in the US economic growth since Q2 2022. Nearly all of the downward revision we got in this GDP report was due to greater weakness in consumer spending, and specifically consumer spending on goods, on durable goods. Fidelity reported this week that in Q1, they had minted about 485,000 new 401k created millionaires amongst their account holders. This was a 15% increase from last quarter and a 43% increase as compared to this time last year. Fidelity said that amongst these newly minted millionaires, The average time spent investing was about 26 years, and these millionaires contributed or saved an average annual contribution of about 17%. TSMC, or Taiwan Semiconductor, the world's largest advanced semiconductor manufacturing company, this week they told us that their advanced semiconductor manufacturing capacity was already fully booked by both Nvidia and AMD all the way through next year, 2025. Now, Taiwan Semiconductor, TSMC, is the most advanced semiconductor chip manufacturer in the world today. And they make these advanced semiconductor chips for companies like Nvidia, AMD, Apple, ARM, Qualcomm, and Broadcom. TSMC anticipates that the revenue contribution from their data center business, from this AI GPU business, will more than double this year in 2024. They expect a 50% compounded annual growth rate for their AI business over the next 5 years. Now, TSMC is located around the world. They have manufacturing facilities all over the world, but most of their manufacturing happens in Taiwan, on the island of Taiwan. And we've discussed the global or the geopolitical risk in that region. We've talked about the fact that there is political tension today between China and Taiwan, as well as the US. China claims that Taiwan is still part of their country. US Secretary of Commerce Gina Raimondo, this week she said that if China invades Taiwan and takes control of TSMC, it will have an absolutely devastating impact on the US economy. Any tech or semiconductor investor considers this geopolitical risk to be one of the biggest risks to their investor portfolio today. As a tech investor myself, I completely understand, acknowledge, and accept this risk today. And given this, we did learn this week from TSMC and Taiwan's administration itself that these big chip machines, the big manufacturing machines that they use to manufacture these chips, these machines by TSMC can actually be shut off remotely if China happens to invade Taiwan. Taiwan's new technology minister, Wu Cheng-weng, he confirmed that these machines that TSMC buys from this Netherlands company ASML, these machines can be remotely disabled in the event of a conflict. Now, ASML Holding, it's a company based in the Netherlands. They also confirmed that this is true and possible. This Netherlands company has run simulations on a possible invasion in order to better assess the risks and these shutdown capabilities. These large advanced chip machines are called EUVs. They're about the size of a city bus. And an EUV requires regular servicing and updates. And as part of this ability to service and remotely update these machines, as part of that, ASML can remotely force a shutdown, which would act as a kill switch against those machines. ASML, by the way, is the world's only manufacturer of these machines. They're based in the Netherlands, and these machines sell for about $217 million each. This week, the US announced a series of higher tariffs on advanced China goods like Chinese semiconductors, Chinese EVs, and even Chinese clean energy and solar components. These tariffs will go live on August 1st. Now, Nvidia and AMD also got some more bad news this week from US administration officials. They found out that these US officials were slowing the approval of licenses for the selling of large-scale AI GPUs to the Middle East. Now, these kind of restrictions are already in place for Nvidia and AMD when it comes to selling of GPUs to China. And now US officials have expanded those restrictions to some Middle Eastern companies as well. We also got an interesting development in the GLP drug space this week. We learned that Hims is an online medication subscription service provider. We learned that Hims is going to start providing GLP-1 like medications as part of a subscription service. Now, the stock rose more than 20% when this news broke. But it was revealed later on that they were not really offering the real thing. They were not really offering the original GLP-1 drug. What they were offering to subscribers is actually a compounded equivalent or a similar drug cocktail that's cooked up by a pharmacist. Now, this is all legal to do. It's allowed to do this to sell these kind of cocktails for certain scarcely available drugs. And today, GLP-1 drugs are considered to be scarcely available medications. So HIMSS is able to do this legally. That said, doctors have warned that the efficacy of these compounded drugs have a mixed record. These cocktails are not FDA approved, and especially the GLP-1 cocktails seem to have some unwanted, unwarranted medical or health issues. They do not always deliver the expected weight loss results to their patients that take them on a regular basis. In terms of the Q1 earnings season, we're in the last legs of the Q1 earnings season. Salesforce's stock, CRM, is the ticker. That stock plunged about 20% after the enterprise software giant reported their first quarter results. Their guidance missed estimates. Their guidance for the next quarter missed analyst estimates. They did report strong numbers, but they also told investors that they are seeing some continued macro pressure and it's taking longer for them to close out certain large enterprise deals. Now, based on what we learned from CRM, today several software company stocks took a major hit in their stock price. Investors are not sure right now if generative AI is truly a growth tailwind, or right now if there are some competitive headwinds that need to be factored into our investing thesis. There's also a growing question of whether these enterprise software companies are seeing more sales pressure today as compared to last year and certainly as compared to earlier this year. Are customers scaling back their software purchases to fund their rising investments in AI? I mean, all this could make sense, right? Because companies typically have rather fixed technology budgets. And if they have to spend more in one category, let's say they have to spend more on AI, they have to look to make cuts somewhere else within their IT budget. And possibly they're looking at enterprise software licenses or enterprise software expenses as a possible category. S&P 500 companies on average are reporting earnings growth of about 6% in Q1. This is the highest since Q1 of 2022. More than 78% of companies beat earnings estimates in this quarter. Now, on the face of it, this sounds really good. But as we learned earlier in this podcast in previous episodes, management teams over time get better and better at playing the beat and raise guidance game with analysts. What happens is that they provide their guidance for the next quarter in the quarterly earnings call. Then throughout the quarter, they keep in touch with analysts and they try to cajole them to tweak their analyst estimates lower as business conditions change. And therefore, throughout the quarter, analysts continue to tweak their estimates lower as they get what they consider to be real-time, in-the-moment updates from management teams. This allows the management team to report a beat and a raise when they report the next quarter's earnings report or the next quarter's earnings results. As investors, we should be able to easily read through these shenanigans. If a beat or a raise is, let's say, 1 or 2% here and there, that's not really meaningful enough to either jump into a stock or to sell everything if the thesis is broken. Only a beat or a miss of over 5%, let's say 5 to 7% or more, only a beat or a miss of 5 to 7% or more is significant enough to perhaps take some action. This would prompt us to dive deeper into understanding what has happened, what has changed within the business to cause that major beat or that major miss. Today, we're still seeing many companies focusing investor attention on margins and cash flows rather than revenue growth. Remember, we learned last week that while earnings are expected to rise significantly in Q2, Q3, and Q4 this year, revenues or sales are not expected to grow as strongly as earnings are expected to grow. This is confirmed somewhat by this week's lower Q1 GDP reading of 1.3% for the US economy. And even the forward Q2 reading for the US economy came in at about 1.5 to 2% for each of the upcoming 3 quarters. So companies are expecting revenues to be lower through the rest of 2024, and they're looking to shore up their share prices by boosting talk and focus on earnings. They're looking to boost earnings by cutting costs, and the largest cost line item for most companies is labor. And after that, it's usually tech expenditure or tech budgets. If we listen to what companies are saying in earnings calls, they're talking a lot more about cost controls and cash flow generation. As per Callum Thomas, a Substack writer, Callum said that the optimistic take would be that companies are thinking of ways to use AI and new technologies to improve efficiencies and reduce costs and therefore increase earnings or margins. The pessimistic take would be that this is a warning sign and a prelude to indiscriminate cost cutting and an economic slowdown as companies see lower revenues and sales. And the realistic take, according to Callum, is probably that as inflation comes down, this means lower nominal growth, lower sales growth, and therefore the need to squeeze out the same earnings growth that you need to pull harder on the profit margin lever by clamping down on costs. So the investor takeaway from all of this is to pay close attention to the quality of the earnings report when you're reading through or listening to an earnings call. Listen to or pay attention to what the earnings report is telling us directly and indirectly. Just because a stock went up double digits after an earnings report, that doesn't automatically make it a buy. Look at forward revenue growth and earnings projections. Look for secular tailwinds and competitive dynamics. Look for higher margins and pricing power. This is absolutely important. Look for pricing power. Look at the health of the company's balance sheet. If the economy slows down, the quality of the business becomes of utmost importance to protect our precious portfolio returns. Now let's turn our attention to AI. Today I want to dive deeper into the state of AI to answer a few important questions. Sure, we've been talking a lot about artificial intelligence recently, and that is by design. AI is one of the leading catalysts in today's markets. As tech investors, as growth investors, we cannot ignore this secular tailwind. If we're not invested in AI, then we're missing out on potentially the most significant upside potential that our portfolios could see in the next few years. As per Goldman Sachs, at about this time last year, there were 4 big positive drivers for tech stocks. Looking at market conditions at that time, valuations were relatively lower, positioning was relatively moderate, earnings momentum was more positive thanks to the great cost cutting that tech stocks or tech companies had done in 2022. And the final aspect, the fourth aspect, was that AI was still young and promising. But fast forwarding to today, Goldman Sachs estimates that today we only have about 1 to 1.5 of those 4 positive factors going for us. Valuations and positioning are no longer helpful. They're overbought and overpositioned today in tech stocks. There still seems to be some earnings momentum, as we know that earnings estimates for the rest of the year are higher through the end of the year. But it's not as much as before. We're trying to squeeze more juice from that same lemon that has already been squeezed over and over. AI today is the only factor that is still firing on all cylinders, and that's why Goldman Sachs believes that it is still too early to sell because AI is still one of those 4 factors that is still supporting markets and has the potential to send markets higher. But we have to be cognizant of this changing landscape if we look at today's markets versus markets as at this time last year. Clearly, the AI trade has been in silicon or in semiconductors for the past 18 months, and then it expanded into power infrastructure. This year, in fact, it has expanded into power companies and utility companies. We discussed this power theme last week in this podcast, and I shared my best idea in that space in last week's episode. So the question is, what is next for AI? What will continue to drive AI-related returns higher from now on? It's either or both of one of two factors. One, we have new smartphones and AI PCs that are coming into the market. So smartphones and computers are likely to get upgraded as new smarter AI-enabled PCs and smartphones with more advanced AI language model software engines and more lower power advanced GPUs embedded in them as these devices become available for purchase later on this year. The second factor that could take AI investors or AI investments higher is the application layer. Perhaps things like co-pilots and AI software agents on our personal devices and on our business devices. These could help us become more productive. Now, the jury is still out as to which business model will be profitable in the software space. The market is still trying to figure this out. Investors are investing in software companies across the board. They're investing in data cleanup and synthesis services, companies like Palantir and Snowflakes. They're investing in data management companies like MongoDB. Investors are also pouring money into data movement companies like Confluent. Co-pilot providers like Microsoft and Adobe are also getting new investments coming in, new buyers coming in. AI-infused business service providers like ServiceNow, like Salesforce.com, and even Monday are getting new investors buying their stock. But truth be told, the software angle of AI is still a big question mark. Today's drop in Salesforce and many other software companies raises the importance of this question. I believe that many of these software companies will not make any new AI-related money. Perhaps they'll get a little bit of a boost initially, but that's not going to be sustainable. AI will become table stakes for their business, meaning customers will expect them to provide the AI-enhanced capability within the current product and for the current pricing level. If they don't do this, if they don't provide these AI capabilities for, in double quotes, for free, they will be undercut by a competitor who will come along with a similar or an even better AI software service. We're already hearing about how Microsoft is giving away their Copilot for free, included in large enterprise deals. This week, I was talking to my neighbor who works for a growing pharmaceutical company. She told me that in their company, only their scientists who are involved in scientific research are allowed to use AI tools on their work computers. All other employees cannot use the Microsoft Copilot, for example, because that company's management is concerned about Copilot inadvertently accessing their precious, secure corporate data. If we consider Microsoft as an investment, for example, what investors now want to see from Microsoft is the ability to both invest in AI and grow revenues from that investment, as well as to protect the margins by managing their non-AI businesses well. Most companies cannot do that. For most companies, the clear path to monetization is not that clear. Now, NVIDIA has an 80% non-GAAP gross margin. This gross margin is being financially supported by companies like Microsoft and Amazon and Meta that are spending billions of dollars on AI infrastructure build-out, AI cloud build-out, billions of dollars on new CapEx spend this year and also slated for next year. Most of this spend is still in the experimental phase, far from deployment and far from actual business usage. Goldman Sachs thinks that when we get to the second half of 2024, and we're just about 1 month away from there, folks, Goldman Sachs thinks that when we get to H2 2024, there will be a clear shift in tone from investors. Investors will start demanding a clear path to monetization. They will start demanding an ROI on all of this AI capex. Otherwise, these stocks will start getting punished. The Weekly Stock Bullfinder, another very talented Substack writer, he wrote about this week. We learned from Weekly Stock Bullfinder that Tianji Zhang, who's the co-founder and CEO of Aave Point, ticker AVPT, So Tianji reported that they had conducted a survey of about 800 organizations globally, and they found that 83% of those companies plan to increase their AI spending this year, and 60% of them plan to allocate at least 25% of their technology budget to AI over the next 5 years. However, their survey also confirmed that there is a significant gap between these ambitious plans by all of these companies and the reality that they face in terms of their readiness to adopt and use AI. Simply put, these companies are not ready to deploy effective AI strategies because their data sets are not in good order. Their databases are not in good order. According to a recent research from Gartner, 72% of organizations believe that oversharing or exposing sensitive business data is the biggest risk that they face when deploying generative AI applications, such as Copilot for Microsoft 365. 71% of organizations are concerned about data privacy and security, and 61% are worried about the actual quality and organization of their data in terms of being ready to use that data in AI solutions. The report found that nearly 50% of these organizations lack just basic measures like archiving and retention policies, and 29% of these organizations are not even automated when it comes to managing their data. Now, we know that a healthy data set is essential to an effective AI strategy. An effective AI strategy can make good business sense because it could help that company, that business, reduce their costs and address operational challenges. Another additional benefit of an effective AI strategy is a possible improvement to overall employee experience. For example, Gartner finds that AI could drive productivity gains by up to 20% if properly adopted within a business. Why does that matter? Well, research shows that more than 60% of an employee's typical workday is lost to repetitive and mundane tasks. Even knowledge workers spend about 25% of their time searching for information. They use an average of 6 to 8 applications to complete a single process. If AI can successfully mitigate these employee frustrations, companies can retain talent, reduce turnover, and reduce operational costs, thus further strengthening their business results. Bill McDermott, who's the CEO of ServiceNow, ticker NOW, he recently shared that their software engineers are now accepting about 48% of text to code generation. So the AI Copilot is automatically coding or saving those software engineers about 48% of their time by auto coding the programs that they need to develop. These are very meaningful productivity improvements, and this is only the beginning. But all of this can only become a reality when the company has clean, organized systems, clean, organized business data that is accessible in a secure and properly managed, permission-driven technology stack or platform. And achieving this is easier said than done. Companies are also becoming increasingly nervous about doing this in the cloud. They're trying to at least partially mitigate the security risk that I just talked about. They're trying to partially mitigate that security risk by bringing their AI solutions on-prem within the four walls of their business. On-prem is cool again, said Jensen Huang at the recent NVIDIA Q1 earnings call. So much of AI depends on training, fine-tuning, and drawing inference from large and small data models, large and small AI engines, all of which require a lot of compute and networking resources. The large hyperscalers have been convincing these companies, these customers, that they should do the bulk of this AI processing on the cloud. However, there seems to be a subtle but profound shift in infrastructure preference from the public cloud to the private cloud. In April last month, Barclays conducted a survey of about 100 CIOs, and they found that 83% of those CIOs said that they plan to do more of their AI workloads on-prem rather than in the cloud. They plan to do the bulk of their AI work within their own private cloud environment. This is a noticeable shift, and this needs to be paid attention to by cloud investors, by tech investors, and certainly by hyperscaler and AI investors. Data as a valuable resource is not a new idea. Before AI, the hyperscalers spent years convincing large companies that it was safe to store their data elsewhere, store their data off their premises in the cloud to reduce operational cost, to make their IT backends more efficient while still being able to derive value from their data, from that business data, through various cloud big data tools like Snowflake and Databricks and Redshift, just to name a few. But with AI now, these companies and even governments are becoming more and more possessive about their data. They're becoming more and more worried about the risks of data leakage while that data is being housed in someone else's data centers. Now, don't get me wrong, I do continue to believe that the long-term outlook for cloud is very strong. The long-term outlook for AI in the cloud is also very strong. Accelerated computing in the data center, whether it's in the cloud or on-prem, is estimated to grow 32% year over year by the year 2030. McKinsey estimates that AI innovations will unlock something like $4.4 trillion of economic value annually. IDC estimates that we will see $11 trillion positive impact from AI over the next 3 years. They estimate that businesses will spend more than $500 billion on generative AI solutions in 2027 at the end of this 3-year period that we're talking about. We talked about TSMC. They forecasted that their AI-related revenues will grow at a 50% CAGR over the next 5 years. And their revenues from AI will grow 164% this year itself in 2024. TSMC recently announced that their April sales grew 60% year over year and 21% month over month. So just between March and April, their AI sales grew 21%. TSMC's biggest constraint to satisfy all of this demand for AI semiconductor manufacturing is the capacity of their manufacturing fabrication plants. But TSMC confirmed that they are confident they're working to more than double their capacity this year, but it's still not going to be enough. And who's buying all these AI GPUs from NVIDIA and AMD? Well, as I said, it's the CapEx spending spree by the hyperscalers. Alphabet's CapEx is set to increase by about 91% year over year. Microsoft CapEx is going to increase by 66% year over year. Amazon and Meta and Oracle, the 3 other large hyperscalers, have similar large CapEx expenditure plans for this year and next year. On their earnings call, Tesla also confirmed that they are planning to increase their own purchase of NVIDIA H100 GPUs. And they use these GPUs in their AI infrastructure to train their full self-driving models, as well as to train their advanced robotic automation software models. Tesla plans to increase their AI spend by about 143% year over year just this year. They noted that they've already installed about 35,000 of NVIDIA's H100 GPUs in their supercomputers today. And they have said that they would buy any and all of the GPUs that NVIDIA will make available to them for purchase. So what's the investor takeaway from all of this? We've talked about the positive and rosy side of investing in AI and all of the hot potential and all of the great demand for AI solutions. And we've talked about all of the risks of investing in AI. So what's the investor takeaway from all of this? Well, there are several takeaways, and actually many of them are questions. They're open questions, and we don't have answers to all of these questions. One, we know that NVIDIA is already the main beneficiary of all of this AI CapEx spend, all of this AI tailwind energy. There are also companies like AMD and ANET and Dell that are also benefiting from this CapEx spend. Today, NVIDIA chips and software products have become indispensable. This has enabled the company to become a $2.7 trillion mega cap company today. So the major market concern now that we have about NVIDIA is that this company, this stock, could hit an air pocket as demand for AI solutions will peter off at some point in the near future. This current GPU capex boom could end sooner than we think. Investors and traders are actively discussing and debating these very questions. When will NVIDIA's product cycle turn lower? Remember, NVIDIA is a product company, and product companies always have business cycles that go up and down. So when will NVIDIA's current GPU product cycle turn lower? When is it a good time to buy NVIDIA if one doesn't own it today? And when is it a good time to sell or even trim one's NVIDIA position if one already owns it today? I personally have about a 17% current allocation to NVIDIA. And this question is very, very important to me, and I'm actively trying to decipher the answer to this question myself. This is one of the major risks in the market for the second half of this year, and we're very soon entering the second half of 2024. This is a major risk not only for AI stocks and semiconductor stocks, but for the market as a whole. Because these mega cap stocks and these semiconductor companies and tech stocks as a whole represent a larger and larger portion of the S&P 500 index and a lot of the other US market indexes as well. Now, NVIDIA doesn't disclose who their customers are, but Josh Brown from the Compound and Friends, Josh Brown looked more closely at their recent 10K annual filing. Now, the company said that one customer represented 13% of all of their revenue today in their compute and networking segment. And there's also an indirect customer that purchases NVIDIA products through third-party integrators and distributors. And this indirect customer today represents about 19% of all of the company's revenue in their critical data center segment. Mega cap companies like Amazon, Meta, Microsoft, and Alphabet today are believed to be NVIDIA's biggest customers, representing about 40% of all their data center revenue today. Now, if there's any slowdown in the capex spend by these hyperscalers, if there's any slowdown in the cloud services sales by these hyperscalers, if there's any slowdown or hesitation in the AI business for these hyperscalers, then you bet that they're going to slow down their capex spend with NVIDIA and other AI solution providers. And that's when NVIDIA stock and other AI stocks are likely to take a hit. So it is absolutely important for us to know, or to get a feel for, to get a good sense for how NVIDIA's business is performing on a quarterly basis and when that business is likely to slow down. We should be actively looking for a good canary in the coal mine that we can follow in order to answer this question. That is the $3 trillion question that today's markets are grappling with. So what's coming up in the markets over the next 2 weeks? Well, next week, Monday, June 3rd, we get the ISM manufacturing report for the month of May. On June 5th, Wednesday, we get the ISM services report for the month of May. On Friday, June 7th, we get the US jobs report for the month of May. On Tuesday, June 11th, we will get the NFIB Small Business Index report for the month of May. This is another leading macro indicator that I follow. Tuesday, June 11th is the US Fed's June meeting, day 1. Wednesday, June 12th is the second day of the Fed's June meeting, and we'll get an update on their latest interest rate decision, as well as Chair Powell's press conference that afternoon. That same day, in fact, Wednesday, June 12th, we will also get the CPI inflation report, the consumer inflation report for the month of May. And then Thursday, June 13th, we get the PPI, or the wholesale inflation report for the month of May. So lots of good stuff coming up over the next 2 weeks in the macro world. And that's all I have for this episode of the Market Whispers podcast. Remember to hit the like button if you enjoyed this episode. Do drop me a comment or a question anytime. I always love to hear from you readers. Until we chat again, good luck in the markets. Stay healthy, stay safe, be kind to others, and take some time to do something you enjoy. After all, that's why we invest: for life, for love, and for happiness. This is Beachman signing off. Thank you and goodbye.